Did you know that the start of this decade is the weakest start to any decade in the last 30 years? This decade has already seen global pandemics, escalating geopolitical tensions, and a worldwide recession. So in this video, let's look back to see how we got to where we are today and project some of those stories forward to see what the global economy will look like in 2024 and beyond. How will we do that? Well, the World Bank just published their annual review of the global economy and their predictions going forward. 250 pages of dry and, if I'm being very honest, boring, but very important economic data. I've gone through all of it, so you don't have to. If you appreciate that as you're going through the video, make sure to smash the like button and share it with a friend. For more context, the World Bank turns 80 years old in 2024 as it was formed in 1944 at the Bretton Woods Agreement. This was an economic conference held in the United States where representatives from 44 countries met to discuss economic and monetary policy as the Second World War was nearing an end. Fast forward to today, and the World Bank has 189 member countries and has given out almost $46 billion in financial assistance. But they also hold every piece of economic data you could hope for and provide forecasts and projections and case studies for every country and region around the world, which is what we're going to be focusing on today. After going through the 250 pages, it's very clear that the World Bank believes there are four main topics that will have the largest impact on the global economy. All four of these are a small piece to the World Bank's logic of why we are in the middle of the weakest global growth performance of any half decade since the 1990s. So for the full context, make sure to stick around to the end of the video. The first topic shouldn't be much of a surprise because it's global trade. The World Bank shared that global trade for goods and services was very flat in 2023, only growing 0.2%, which is the slowest expansion outside of all the global recessions in the last 50 years. And if we look at this chart, the World Bank projected global trade to be at 2% for 2023, a number that was not met because of prolonged pandemic disruptions and global supply chain pressures, but they expect the global trade economy to recover in 2024. It can't be overlooked that the country most frequently discussed in this section was China, and to be honest, that makes a ton of sense because the world focused much of 2023 on de-risking their supply chains and manufacturing away from China. The World Bank specifically mentions how the US and European Union accelerated reshoring away from China to reduce exposure to adverse shocks. And they go on to say that a continuation of this trend could result in a more fragmented supply chain and slower trade growth than projected in the baseline. This is a very important talking point, so let's dive a little deeper. The World Bank mentions reshoring, but really there are two subcategories that escalated significantly in 2023. The first is called nearshoring, and this practice is when you move the production of your goods or services closer to the consumer base to avoid delays. And if we use the United States as an example, this meant moving manufacturing to places within Latin America like Mexico. The next one, however, is more of a geopolitical move, and it's called friendshoring. This is simply when you move business to countries with stronger economic or political ties. And if we use the United States as an example again, this meant moving business to countries like India, Vietnam, or Singapore. And this has been having an impact on China's exports with this recent story that China's annual exports fell 4.6%, the lowest since 2016. This chart showing China's trade surplus helps us tell the story. The dark blue section is the trade surplus China has with the United States, and the yellow section is the trade surplus China has with the European Union. Naturally, these trade surpluses went down during the pandemic, came back up a little bit, but have been on the decline again the last year plus. And I understand these things can be cyclical in nature, but it does help paint the picture. And with China needing to fill this gap from somewhere else, it's not a surprise to see exports to countries like Russia skyrocket. Ever since Russia's conflict with Ukraine, Russia hasn't really had many places to turn when it comes to trade, but there have been other global conflicts that the World Bank has been keeping an eye on, which is topic number 2 of this video, the commodities market. Their findings showed the average price of most commodities fell in 2023, things like energy, metals, and agriculture. But despite this, they remain up more than 40% pre-pandemic levels. As expected, crude oil prices were volatile in 2022 and stabilized a bit in 2023, as we can see by this chart. The light blue line represents 2022 and the darker blue line represents 2023. Currently, OPEC reserves stands at just over 5 million barrels per day, with Saudi Arabia having the largest. The World Bank expects oil prices to edge down in 2024 as global global activity slows, and no surprise, they predict that an escalation of the conflict in the Middle East is a major risk to oil prices. They even charted some of the other significant events throughout history. Events like we're seeing today have had a tremendous impact on oil prices, reducing up to 6 million barrels a day in some examples. But it's not just energy that has concern from the World Bank in this region, but supply chains in general. Recently, there have been many attacks on cargo ships and oil tankers in the Red Sea, one of the largest, most important trade routes in the world, connecting itself to the Suez Canal, which sees 15% of global trade flow through it. And this is a problem because it's the shortest path from the South China Sea to Europe, for example. So for the safety of everyone involved, many shipping companies have restricted their boats to travel through there, meaning the next best way is all the way around Africa, causing delays and increased costs. So this will obviously have an impact in the short term, but as this story develops and as this region stays off limits for global trade, the larger the impact it will have. The World Bank's next general topic was talked about a lot in 2023, with Argentina being the poster child for it, and that is inflation. But before we get into that, I make videos about world news impacting the dollar, so if you like topics like this and want to see more of them, make sure to subscribe to the channel and let me know down in the comments what topic you want to see next. Argentina's annual inflation topped 200% for the highest mark in the last 30 years. But how has the rest of the world been faring? The World Bank highlights two different ways that they look at inflation. One is called headline inflation and the other is core inflation. Headline inflation includes inflation in a basket of goods that includes commodities like food and energy. It is different from core inflation, which excludes food and energy prices when calculating inflation. The World Bank reports that global headline inflation declined substantially in 2023. As we can see, advanced economies and emerging markets have similar trajectories. But if we look at countries with inflation above target, you can see the advanced economy have been more volatile when it comes to staying above their inflation projections, with countries like the United States and Eurozone being key contributors to that over the last couple years. Speaking of the US and Europe, the World Bank highlighted the rotation of demand from goods to services continuing. Declining goods inflation amid easing import prices was particularly offset by persistent services inflation tied to tight domestic labor markets. And as a result of this, core inflation, which surged less than headline inflation in 2021 to 2022, has also declined less since its 2022 peak, again being split up by advanced economies and emerging economies. The World Bank then uses the United States and the Eurozone as an example to explain why inflation going down doesn't always mean the same thing, and it's not always for the best reason. For the US, reduced inflation was because of resilient activity and low unemployment, thanks partly to increasing labor supply, improving supply chains, and falling oil prices. The Eurozone, on the other hand, saw its inflation drop as it was accompanied by weak growth, reflecting the negative supply shocks from earlier sharp energy price increases. Overall, the World Bank sees global inflation declining further in 2024 and 2025 due to less global demand growth and lower commodity prices. The final topic that the World Bank gave for its global financial update might be the most polarizing. When talking about the global financial developments, the fourth topic, the World Bank kept mentioning policy changes. And I know policy changes are important for countries to keep adapting and keep evolving, but I was reading a little between the lines here, and it's very hard to ignore the elephant in the room. 2024 will be known as the greatest election of all time. Over 40 countries have their general elections this year, which equates to 3.2 billion potential voters, 41% of the world population, and $44.2 trillion of GDP. Countries like India, Mexico, South Africa, Belgium, Pakistan, Venezuela, Taiwan already had theirs, the UK, and oh yeah, the United States. So I think it's safe to say that policy changes will be a large part of 2024, but here is what the World Bank has to say on it. They believe monetary tightening in advanced economies is concluding, with easing of policy interest rates to go back to its regular pace. This, alongside softening inflation like we discussed earlier, could keep real policy rates elevated for an extended period, following the largest and fastest increase in real US policy rates since the early 1980s, as we can see by this chart. And advanced economy government bond yields, otherwise known as a country's debt, reached their highest levels in October 2023 since the late 2000s. Yields have pulled back since the peak, but it does show that these advanced economies have a high risk appetite. Emerging market central banks have started cutting policy rates, with further reductions coming in the near future. The World Bank continued by saying, unlike other large emerging markets, China has undergone a period of notable financial strain. Slow growth prospects and a complete overhaul in the property sector have contributed to debt defaults by property developers, net sales of debt and equity securities by foreign investors, and a decline in the exchange value of their currency. But this chart is a great way to show the real debt ratio for China versus the US versus other advanced and emerging markets around the world, and as you can see, the US debt ratio sticks out like a sore thumb, which begs the question, does the United States have a debt problem, or is this something that they can get away with because they're the largest economy in the world? There's too much to unpack for that topic in this video, but I made a playlist diving deep into the US debt crisis, the implications this debt has around the world, and a new record that the US government just set, one they shouldn't really be that proud of. So if any of that interests you, make sure to check out this playlist here.